Good afternoon or good morning, everyone, and welcome to our webinar for today. As you can see, we have a little bit of a different format today, in that today will be an Ask the Expert session. So we have compiled a number of questions which have been submitted by our LRC members, and today I will be firing those questions at our two experts that we have. So on the screen you will see Adrian Bailey on the left, who is the principal of our Sydney office, and also joining us we have Paul McEnroth, who is a principal in our Brisbane office. And so both Adrian and Paul will be answering a number of questions for all of you today. Brett Hart, the other principal of our Brisbane office, was going to be joining us today, but unfortunately has been called into an urgent client meeting, as sometimes happens. So we will see how we go with the questions that we have, but in the event that we do have some additional time at the end, if you would like to submit any additional questions, you can do so by clicking on the chat function on the right-hand side of the screen. So if you think of anything, feel free to type that in, and if we have time at the end, I will ask those questions to Adrian and Paul. There is also the option to download the slides from today, which just set out the different questions that will be asked in today's webinar. So you can do that one by clicking on the Files tab and downloading the PDF that way. Just to let you know, today's webinar will be recorded and made available on our website at a later time. And there will also be a feedback email circulated after the presentation. So we would again be grateful if you could take the time to complete that survey, because we do like to tailor our presentations to the topics that interest our LRC members. So we'll be grateful for your feedback in that way. So I think we will kick off with our first question, which is directed at you, Paul. We have a few questions on discretionary trust, which we will start off with. And the first question we have comes from Liam Dunn of Harrison and Gill. So thank you for your question, Liam. The question is, what is the ATO's current position on a beneficiary with an unpaid present entitlement gifting their loan account to the discretionary trust? For example, a discretionary trust has been trading and made distributions to their elderly parents. The parents are not interested in receiving the money and would like to gift this to the trust for the benefit of their family. I'm aware of the reimbursement agreement issues and understand the ATO was looking to update their position, but not sure if anything has transpired.
Thanks, Kate. And yeah, thank you, Liam, for your question. This one is actually the subject of a couple of questions today. And, you know, it's a common issue that arises. The ATO's position is still unclear. They certainly look to use the reimbursement agreement, or Section 100A, in more and more tax matters that they review. But their position on, you know, what is a reimbursement agreement and whether this circumstance would fit within that is still unclear. As you said, there was a ruling to be coming out. It was due out earlier this year. It's been pushed back a few times, the release date, and I looked yesterday, and effectively they've changed it to be advised. So they've taken off kind of a date to make it more open-ended as to when they're going to release their ruling. The ruling is said to include a significant number of examples. So we'll wait and see, I guess, what those examples look like and whether this scenario fits within that. We think the delay may have something to do with a case that was before the federal court, before Justice Logan earlier this year. It went to trial in May, and the Commissioner had assessed on the basis of both Part 4A and Section 100A. And we're told that the taxpayer was, I guess, defending the 100A argument on the ordinary family or commercial dealing aspect. So not sure of the facts, but we think that may be one of the reasons for the delay, as they want to work out, well, where does the court land in that case? So unfortunately, we don't have a great deal of information as to what the Commissioner would make of this scenario and whether, and I guess when that ruling will come out. Hopefully it will cover examples like this, hopefully in favour of the taxpayer, rather than saying that this arrangement is something that would be caught by Section 100A.
Great, thank you, Paul. I'll pick on you next, Adrian. So the next question we have comes from Daniel Bayjoon at DBC Advisory. And the question is in relation to the Foreign Beneficiary Exclusion Amendment for discretionary trust deeds. So if a discretionary family trust owns property located in New South Wales and has made an irrevocable foreign beneficiary exclusion, is it a problem if one of the listed beneficiaries is a foreign person? The exclusion should negate any distributions to that person, but they are listed on the deed.
Thanks, Kate, and thanks, Daniel, for the question. I mean, in short, the answer is no, there shouldn't be any issues. If the two requirements that the OSR or the legislation requires and the OSR have interpreted this way is that you have varied the deed, so you've excluded all foreign beneficiaries, and that provision can't be changed. So I recognise that the person's name will be on the deed, that will always be there, but by varying it properly and revoking them as a beneficiary, then there won't be any issues from a land tax perspective. That's all I've got for that one, Kate.
All right, thank you. Next, I have a short question for Paul. In relation to discretionary trusts, can a poorly drafted resolution containing ambiguity be rectified at a later date? And if so, how can that be done?
Yeah, I mean, obviously it's going to depend on what the nature of the ambiguity is, the nature of the resolution, but there should be no reason why an ambiguous resolution can't be rectified at a later date. How would you do it? Now, this is the question that clients never, or the answer is clients never want to hear, is the best way is to go to court and get a court order applying the doctrine of rectification. And what you have to do under the doctrine of rectification is show that the document was ambiguous or it stated incorrectly the actual intentions of the parties at the time. And things you'd need to look at are, well, do the actions of the trustee, for example, or a company, do they match what they're now saying was the true intention at the time? So it is about that evidence surrounding their intention and whether the facts that happen subsequently match that true intention. If they line up, then you can apply to the Supreme Court to rectify the document. Clients will not want to do that unless the circumstances, it may be that the consequences of, the resolution failing, for example, the consequences could be significant. In that case, it may justify going to the court. What clients will tend to do is do some sort of deed of rectification, which is kind of a halfway measure. It's saying, well, we, the parties to this resolution, certify that this is our intention, even though the document was ambiguous. Whether that satisfies the commissioner or not, if it's a taxing matter, oftentimes they will say it doesn't satisfy them. And, if the matter were to go to an amended assessment, you may need to go to the court and get a court order for rectification if that's possible.
Okay, thank you, Paul. I will hit you with another one while you're there. So if the trust has accumulated accounting losses in it, that these losses need to be recognised within the profit distribution resolution and noted that they need to be deducted from net income first? Or is it assumed, a bit like dividends, that you cannot distribute profits without first deducting these accumulated losses from prior years of the current year's profit before any distribution is made?
Yeah, thanks, Kate. Distribution resolution or minute of a meeting won't generally cover the machinations of how you get to the net income figure. Generally, what a resolution will include is a determination of how the trustees are to determine their income. So whatever the particular deed says, it might have the phrase net income, or if you use our trust deeds, it'll say distributable income. There'll be a resolution that the trustees determine what that distributable income is and then distribute that amount to the beneficiaries. There's obviously other resolution parts that would make up, I guess, income, being capital gain streaming and franked dividend streaming. But generally, as the question puts, those machinations of how you get to that figure are not covered in a resolution, particularly because, you know, in the case of capital gains, you might have a CGT event that occurs on 29 June and doesn't settle till 29 July. In that case, you may not know what those figures are.
Thank you, Paul. I will give you one more while you're on a roll. So with discretionary family trusts, the ATO appears to be legislating against distributions to family members on a lower income, such as students or older family members with lower incomes who are not taking an active part in the trust business. Due to the higher tax rate of 49% within the trust, the trustee would prefer to make a distribution to these lower income individuals. What are your thoughts for the future of distributions to members with a lower tax bracket?
Yeah, and this is that other question on, you know, on Section 100A in terms of reimbursement agreements. It kind of fits with that, I guess, in that legislative framework. We'll see what the Commissioner actually says, but in general, there's no issue with distributing to beneficiaries who might happen to be on a lower tax bracket than others, or certainly the trustee. That is one of the fundamental features and benefits of a discretionary trust, for example. Yes, the Commissioner has an issue with, distributing to children who might not live at home and circumstances like that. But what the Commissioner looks for is, does the financial benefit, which is a phrase they love to use, does the financial benefit follow the distribution? So in that first question we had, a distribution is made to grandparents when the money never goes to them. In circumstances like that, the Commissioner takes issue with it. Whether or not that fits within the ordinary family or commercial dealing, we would say that it does, but we'll see where the Commissioner lands on that point, hopefully in his opinion on Section 100A. It's likely in this circumstance that, you know, the Commissioner will say if the financial benefit doesn't follow the distribution, then 100A might apply, which I guess is our fear about what might be in that ruling.
Okay, now we have a couple of questions which are specific to unit trusts, and I will ask you this question, Adrian. So this LLC member...
Sorry, Kate, before you do, can you just go back to that previous slide?
Yes.
Just because I have the late Michael Hart ringing in my ears at the moment about the statement ATO appears to be legislating. Just a reminder that the ATO does not make the law. They provide their interpretation.
Helpful comment, thank you. So going back to this question, so this particular LRC member has a unit trust with partially paid units. The intention with that unit trust was to pay up the units over a period of time as funds were needed in the unit trust, which were to be applied to constructing a business operation. The unit trust is now looking to sell the underlying assets in the unit trust to a third party to complete the project. The unit trust will make a capital gain on this transaction and then be wound up. The capital gain would be offset and applied for the part payment of the units, but there will still be a shortfall. As there is no need for any further funding in the unit trust, which would have paid up the units, where do we stand with partially paid units when we wind up the unit trust? Can partially paid up units be cancelled on the wind up of the unit trust?
Thanks, Kate, and thank you for the question. It will always depend on the wording of the unit trust deed and whether there's provisions in there in relation to partly paid units. To use our unit trust deed as an example, in that situation, or well, not just in that situation, there's no differentiation between a partly paid unit when you're issuing ordinary units and fully paid units. It goes on the proportion of units that you have. So whereas you would get a slightly different answer, I would think if you're dealing with shares, with units for the most part, there's no issue with cancelling or redeeming a partly paid unit. Yeah, you could just proceed as if it was fully paid, remembering again with our unit trust deed that it's just in proportion of the percentage of units that you have. Thanks, Kate.
Thank you. Don't go off the screen. I'll ask you this question as well. Has there been any ATO audit or review activity into either the issue of special income units and their use, or the issue of income-only dividends and their use as well? For example, if those type of units were issued in June of a particular year and then used to stream $100,000 through on the 30th of June of that same year.
There definitely has been audit activity on the use of special income units or dividend access shares. There was a major audit program undertaken by the ATO some time ago now, back in 2012. It was around about the time they issued their taxpayer alert on dividend access shares. And certainly they did a wide-ranging audit review on anyone that they could identify who had a special class of share issued in the company. Got a few clients who had been part of that audit. For the most part, and I say for the most part because there's always outliers, where you're using them for asset protection purposes, in where, say, for example, you are declaring a dividend on them to a company and parking retained profits there, or where they are going to individuals and the individuals were paying the tax, the ATO didn't have any problem with those clients and closed off those audits and reviews fairly quickly. I mentioned outliers. There's always outliers, and quite often things happen with these shares after they're issued by people like us, the lawyers. And I know of one matter where sometime after they've started declaring dividends via a trust to a non-resident and getting a refund of franking credits, and another matter where they were declaring dividends via a trust to a lost trust and getting refunds again. ATO wasn't particularly excited about either of those occasions, and those matters continued on in terms of audit. But where you're using them in the manner that I've described, I haven't seen the ATO have an issue with them. But there is a matter currently before the tribunal where the shares were used in that matter to declare a dividend to a reserve entity as part of a family group exercise. And the ATO are continuing with that matter on the basis that it is a dividend strip, and that's the argument that they're making. I would expect a decision from the tribunal in 6 months or so, so we'll probably have some further guidance there. It's worth noting that the ATO pursued the clients for another matter first and lost that in the full federal court, and have now come back with the alternative Part 4A assessment. So watch this space, so to speak. But yeah, I have no issues recommending them to clients on the basis that you tell them about the previous audit activity so they can decide whether they want to take the risk and whether used in those sorts of manners.
All right, thank you. We now have a few company-related questions, and I'll ask this one to you as well, Adrian. So in a private company that only has non-redeemable shares and we are liquidating that company, can the shareholders claim a capital loss on those shares?
Yes, you have CGT event C2 occurring on the liquidation and winding up the company, and you make a capital loss in the event that the proceeds that you get back are less than the cost base of the redeemable preference shares. So that's a nice, easy one for me, Kate.
Short and sweet. All right, we'll move on to Paul now, if you wouldn't mind answering this question. So it's in relation to our discretionary dividend shares, or dividend access shares, as some of you may know them by. So under the terms of those shares, they last for 47 months, after which they are deemed to be redeemed. So if we assume that a company overlooks that provision and continues to declare and pay dividends to those shareholders after the 47-month expiration period, The company directors should have resolved to redeem and then reissue the discretionary dividend shares, but they unfortunately failed to do so. How would the commissioner treat those franked dividends which were paid to the holders of the discretionary dividend shares, which were meant to have been redeemed, and what would the consequences be?
Yeah, thanks, Kate, and thanks for the question. This is one that does come up from time to time because these circumstances do happen. You might tell the client, and our letters of advice and obviously recommendation always point out that, yeah, these shares have a life of 47 months, and there's particular reasons for that. But that gets lost to time, unfortunately. And dividends continue to be paid, 6-7 years down the track. Strictly, it is not a dividend, because a dividend under the definitions in the 1936 Act say that a dividend is a payment to a shareholder or a crediting of money to a shareholder, and strictly the holder of the redeemed discretionary dividend shares is no longer a shareholder in that company. In that case, it would be a payment to a related entity of the shareholders in most cases, which then brings into question whether Division 7A might apply. The way we establish these discretionary dividend shares is that the shareholder is always a company. So in those circumstances, it would be a payment between two companies. And obviously we know under section 109K, a company-to-company payment is not caught by Division 7A. So we're outside that realm, but we've still got a payment between two companies. It's likely that the commissioner would treat, if it came up, those dividends as being unfranked, which would in essence be a gift of money from one company to the other. Now that presents a slight problem where the reserve company that has been paid the purported dividend will have money in it with no franking credits. So that is a concern. What we would probably, and we have recommended in the past, is looking at that rectification issue. It was pretty clear on the face of it that everyone, being the shareholder, or the old shareholder, and the company, that they all intended and understood, even wrongly, that that company was a shareholder, and in which case we would probably do a deed of rectification and recommend it be approved by the court. As I said, people are shy of going to court, but at a minimum, look at doing a deed of rectification to, I guess, add in that those, shares were issued.
Paul, just I was thinking while you were explaining, if you went the other way and treated it as a loan, I guess rather than rectification, you could always, a loan, and it's between two companies, so there is no Division 7A issues.
Yep.
Then if you issued the shares now, you could then clearly declare a dividend and offset that against the loan. That might be another approach you might take.
Yeah, absolutely.
All right, I might ask the next question to Adrian. So here we have an example. We have a private company where tax returns are prepared for the 17, 18, and 19 income years, and under those returns, income tax would be payable. That company has money sitting in the bank available to meet the tax assessments, and the company tax returns are lodged with the ATO in October 2021. The resulting tax assessments have not yet been paid by the company, but the intention is to pay it shortly. Is the company able to declare a fully franked dividend between the assessment and payment of the tax, or only after the tax has been paid?
Thanks, Kate. So as we should be aware, either the ability to have, so to speak, a franking credit only arises when the tax is actually paid. So that's the date that if you have franking credit register, you put that amount into as a credit in the franking credits. So the fact that you've lodged the assessments but haven't paid the tax, those are, even though you are holding the cash, those amounts would not be franking credits in the books of the company. There's nothing to stop you declaring a fully franked dividend, but you need to think about what would happen at the end of the year, end of the tax year, in that if you haven't paid the tax by then, you would be in a franking deficit because you wouldn't have enough franking credits if you declared a fully franked dividend, and you'd be liable to franking deficit tax. Now, that's not the end of the world, because there is a provision that, well, I should say franking deficit tax is really a recognition of tax that you were going to pay, and you can offset that against any tax liabilities. So to use an example, if you had a $100 franking credit from paying tax and you had $100 in the account, as long as you paid that $100 by the 31st of July in the relevant tax year, so after the end of the tax year, you've got until 31st of July to pay that franking deficit tax. That would be offset against the company's income tax. So it's not the end of the world, but clearly you'd probably want to make sure that you've got the franking credits at the end of the year by paying the tax. One other point I should raise is that if you have over-franking, which is in essence your franking deficit tax is more than 10% of the tax that you pay or the company pays in a year, then those franking accounts are reduced by 30%. There is an exception to that for companies in their first year. Clearly, they don't tend to pay tax straight away, but something to bear in mind that if you find yourself in the position of franking deficit tax, although you can apply it against the company's tax if paid by 31st of July, you may be in the situation where it's slightly reduced as to what you have. I hope that answer made sense.
All right, thank you, Adrian. We'll now move on to a few business restructure questions. And this first one was submitted by Campbell McEwen at UBT Accountant. So thank you, Campbell, for your question. Question for you, Paul. As part of a restructure, it is often seen where the existing business licenses the goodwill and business assets to a new trading entity to prevent triggering a CGT event or a dutiable transaction, particularly in WA and Queensland, where goodwill is still considered dutiable property. Has this arrangement been challenged and defended in court, and what measures can be put in place to defend this in court, particularly where the business is trading under this structure for 10 or more years and the business has changed significantly, for example, where there's a change of market or product focus? Can the trading entity be deemed to be generating the goodwill, or does the licensor business have a defeasible right to the goodwill?
Yeah, thanks for it's a very detailed question and covers a lot of the issues that do arise in any licensing arrangement. Licensing arrangements of this kind can be fraught with danger. I say can because I've seen plenty that operate quite well. Where there is significant danger is where the clients over time don't consider that there is a licensing arrangement and it's purely an accounting thing, as they might put it, and they don't truly understand the nature of the relationships between the different entities. They might simply consider that their company operates the business and owns it. They might even get to a point where they're selling it and they don't even fully appreciate that their company doesn't own the business. So there's some of those practical issues that do arise. And what happens over time when the clients want to, change the business? They go from selling one item to changing to something completely different. Well, in those circumstances, it's difficult to defend against there having been some form of transfer of business. That there's some of those practical issues that the clients often tell you about after the fact, and you're left trying to pick up the pieces. Have there been challenges in court? None that we're aware of. Adrian and I and Brett went kind of around the table and said, well, we can't remember any. We've certainly had audits for clients that we've implemented licensing arrangement documentation for by the OSR in Queensland, and they approved our licensing documents and the arrangements set up by those clients in those cases. So we haven't had a client go to court, and we're not aware of any. The things that need to be really put in place well and early are, the documents that document the arrangement as to who owns the assets. Working out what the license fee is probably one of the harder parts of that. I don't have any particular magic for you, but that is one of the areas that presents most difficulty, is working out what that arrangement is and making sure the client understands that that arrangement needs to be somewhat set down, and it can't fluctuate simply because, this year we'll just pay less because we don't have as much money. Well, those type of arrangements where they're very fluid and based on purely their circumstances at the time tend to be seen through as a bit of a sham is probably a strong word, but that can be an issue. So documentation and following it is critical in that area.
Thank you, Paul. Next question for you, Adrian, is in relation to the restructure of passive cryptocurrency holdings into a wholly owned company by using the 122A rollover. Would the loss of the 50% CGT discount be compensated by access to franking credits in the new company? Or would it only apply to trading entities rather than investors? In other words, is Division 122A restricted to only business assets? And if so, what is defined as a business asset?
Thanks, Kate. In terms of, I think that was more a comment in the question, the loss of the 50% discount is compensated by access to franking credits in the new company. The short answer is that the 122A rollover applies to any CGT asset. There are some other requirements in terms of residency of the taxpayer, but it would apply to passive cryptocurrency holdings. So it's certainly something you could do using 122A, roll it over into a wholly owned company. The business asset requirement is more a requirement of 328B, which is the small business rollover, which requires the asset to be an active asset under the small business CGT rules.
Great, thank you. Paul, you're back up with this next question. So the question is, do you have any suggestions around how to best approach business restructures in states such as Queensland, where transfer duty may be imposed on the value of the business assets, including intangible assets? For example, where you have a family group, which is restructuring from a partnership or a trust to a trading company. Do you have any suggestions around different structuring options and ways to minimize transfer duty?
Yeah, and obviously I'm from Queensland, so this is a question we face whenever we're talking to clients, and we do that regularly about how to restructure their business away from a trust. And there has been an appetite for that in recent years, particularly when clients, hear about the small business tax rate being, now down, 25%, and they struggle to understand, well, why am I paying so much tax, from my family trust structure? And, stamp duty is the main inhibitor to undertaking that kind of restructure in Queensland and WA. There has been some recent movement on that in the last year. So last year, the OSR in Queensland put out an administrative guideline, which said that they would allow certain types of arrangements, like the mum and dad partnership can transfer their business, provided it's a small business, and there's some requirements around that, which are different to the federal rules. But you can transfer your business to a company that mum and dad own, and they won't impose stamp duty on that. It's a bit of a strange one as to why the OSR, obviously, we have a single House of Parliament here, so they obviously have the authority to do it from their leaders, but why it hasn't been legislated is unknown. But effectively, they're saying, even though the law says the opposite, we'll let you do this type of transaction without stamp duty. They did allow a transfer of a business from a discretionary trust to a company where the default beneficiaries in the trust were the shareholders in the company. Some of the difficulties with the approach that they put forward were that, well, in that circumstance, you would get transfer duty relief, but you wouldn't get relief under the, CGT rules. So it was a bit of an anomaly there. About a month ago now, they put out a further update to that ruling, which said that they would allow a rollover effectively of the business to a company in which the discretionary trust is the sole shareholder. So in effect, slightly, there's different rules, but in effect, it mirrors a 122A rollover under the federal income tax rules. So that was a really positive thing. Now, there are some requirements, and it really is tailored for quite small business in that the dutiable value of the business can only be up to $10 million, but turnover has to be less than $5 million. So it's not going to apply to everyone, but it's certainly a step in the right direction and a start. Our traditional approach, where stamp duty is just it's not going to fit within those new rules, or it's not something the client can stomach paying, is to look at a limited partnership. And the benefits of a limited partnership are that it is taxed as if it were a company. It has a franking account in the same way as a company does. But the taxes on setting up that limited partnership are limited to 1% of the market value of the business. So we would transfer 1% to a new company, and the existing trust or the partnership would enter into a limited partnership where the existing owner owns 99% interest in the partnership, but the limited partnership itself is taxed as if it were a company. So that would be our traditional approach. And we still use that to this day. If stamp duty can't be, fit within these new rules, or they just simply don't want to pay that stamp duty.
Thank you, Paul. Moving on to the next little topic, we have a couple of questions on income tax. And Adrian, this one's for you. We have quite a lovely little story to walk through in this one. So if we assume that you have a client, she's a retired woman, she normally earns about $1,000 in income interest, which is accessible to her. She has a furry friend, a dog, which she walks regularly, and her neighbour often sees her out walking the dog and asks if she would like to also walk his dog for $100 a day. She accepts the neighbour's offer, and she begins to earn an additional $500 per month over the next year, which earns her $6,000 in total. In doing that, in walking the dogs, she doesn't have a business plan. She doesn't market her services. She simply enjoys walking the dogs, and she wants to help out her neighbour. So would the income earned from walking the dogs be accessible to her? Would that be considered a hobby or a business if the commissioner were to look at that income?
Thanks, Kate. $100, is that the going rate for dog walking these days? I might have to get my son involved in it. So the short answer, the practical answer or the real answer, practical answer would be only accept cash and keep it under your mattress. In reality, there's no definition of business within the Income Tax Act. So you look at a number of factors, scale being one of them, repetition, intention to make a profit, business-like behavior, marketing. She doesn't really fit any of those boxes in the story. So I would take the view that she has a hobby rather than a business. Of course, I can't speak for the commissioner, and there's the risk that they would say that it's a business. But yeah, that would be my view, that it's a hobby.
All right, next question is for you, Paul, and it's in relation to the CGT main residence exemption. So if we assume that your client owns a large block of land, 10 hectares, and the client lives in the house on the property, uses it as their main residence. Also on that property, you have a garage and a tractor. How would you account for the main residence exemption when the property is eventually sold? Which parts of the land would attract the exemption and which would be subject to CGT?
Yeah, thanks for the question. It's actually not one I've really come across before, but there is a tax determination which covers this exact point, and it basically says, it's from 1999, number 67, if the questioner is interested. But it basically says that if effectively the taxpayer can determine which part of the 10 hectare block in this scenario, which part of that is subject to the main residence exemption. Subject to, obviously, it will include the area on top, the area, I guess, underneath where the house sits. So that has to be included in the main residence exemption. But the area on which the garage is located and the tractor, well, that may be able to be, put towards the 2 hectare main residence exemption. Now, the caveat is that the land needs to be able to be separately valued. So the client would need to get a valuation which can separate out those aspects or those areas and value it separately. That may be difficult in a lot of circumstances, and frankly, clients probably won't pay to have it valued. If the area can't be separately valued, then it's worked out on an area basis. So whatever the capital gain or loss is effectively, in this case, it will be 2/10 towards the main residence and the balance taxable.
Okay, perfect. We are working our way through the questions, and our next little section is on estate planning. This question actually came from our last webinar on testamentary trusts, and the question referred to an accountant that offered a trustee service to all of his clients, but he made himself a residual beneficiary of the testamentary trust. How do we know that that won't happen again?
Thanks, Kate. That was quite enterprising of that accountant. You can't really stop fraud. If someone's going to go out and commit fraud, there's not a lot that you can do. But what you can do is build in some protections there. Clearly, if the accountant's drawing up the documents and making themselves a residual beneficiary, there's not a lot you could do to protect against that, I don't think. But say if you were drawing up the documents as a lawyer for somebody, and the accountant or anybody was going to offer an independent trustee service, you'd want to make sure that you had provisions in there that exclude them as a beneficiary, and also that require certain decisions to be made unanimously. So that would be one way to protect against it. Thanks, Kate.
Thank you, Adrian. You're up next, Paul. This question is referring to our secure debt strategy. So when the client dies, they have the secure debt strategy in place. What claim on his estate would the bloodline trust have for the outstanding loan? If the loan is called up, do the estate assets have to be liquidated? And what if the client's partner is still living in their home?
Yeah, absolutely. And we use the secure debt strategy as a means of, as a part of estate planning, in that clients may be concerned about challenges to their estate. And, the secure debt strategy does dovetail with their estate planning needs. It is like a debt, like it is owed to the Commonwealth Bank. It is a debt of the estate that would need to be paid out. However, debts don't, in theory, need to be called in if the beneficiary of the estate assumes responsibility for that debt. So in this circumstance, we'll take a fairly simple approach that, the husband in this case has done the secured debt process because he was concerned about asset protection. he dies and the mortgage on the house that's subject of the loan under the secured debt strategy, well, that would remain in place. The spouse would remain in the home, but the house would still be subject to that liability. Obviously, probably the most important part is making sure that clients understand how their wills and I guess their whole estate plan needs to work together with the secured debt strategy so that the right person is in charge of the bloodline trust under the secured debt strategy, so that that person doesn't call in the loan and say, well, I want this money to be repaid. Because in that case, the house, if it is mortgaged in favour of that trust, well, it may have to be sold. So that's why it's important to look at the two aspects together and not simply, consider them in isolation.
Thanks, Paul. Adrian, this is your last question for the time being. So it's a fairly short one as well. So is a testamentary trust subject to land tax? And if so, is there any way to get around that tax?
Can I answer by just saying it depends?
No.
Because it does depend on what state that we're in. Land tax, and being based in Sydney, land tax is a major issue in New South Wales for trusts generally. And certainly testamentary trusts are subject to land tax and don't have a threshold. In other states, such as Queensland, for example, trusts have a threshold, so not so much an issue there. However, based on New South Wales, what you would call a discretionary testamentary trust actually has a land tax threshold for the first 2 years of its operation, but after that is treated as a special trust, so it goes back to not having a threshold. The only way that you could really fix it, so to speak, would be to vary the trust to make one beneficiary the sole beneficiary in relation to that asset or that property, both from a capital and an income perspective. By doing that, you're fixing the land tax issue, but you're no longer having the benefits of a testamentary trust in terms of asset protection if that individual gets sued, or flexibility in terms of capital or income. So it is an issue. If we want to have the property in a testamentary trust in New South Wales, then we've got to be recognised that we will be paying land tax above what we would otherwise.
Adrian, I'll just add to that for the Queensland viewers that if the property is in a discretionary trust or a testamentary trust, and there is a primary beneficiary who lives in that residence, they can get an exemption from land tax. But they have to effectively live there.
Yeah, and there are some similar provisions in some of the other states along those lines. Either live there or it's creating a life interest.
The only difficulty in Queensland is that if, for example, you distributed to a company, that does interfere with the ability to claim the exemption. So, there are pros and cons, and the client's just got to weigh all of them up at the time.
All right, we're now up to the last question on our list for you, Paul, on SMSFs. So we have a company which is not subject to single touch payroll. It pays a salary sacrifice super amount to an industry super fund. There's a new bookkeeper brought in who uses the incorrect code when making the payment, and the payment is treated on the books as an employee contribution by the fund and not a salary sacrifice amount. Upon realising the error, the fund is advised of the error, but the fund says that they cannot adjust it because the member had a drawdown of the fund. The fund is still operating today. The company return would still be correct, as instead of super, the amount would have been classed as additional wages. However, this would then create a Division 7A issue, and ultimately the fund should have deducted the 15% on the contribution. How is a humble, hardworking accountant supposed to correct this error? Or instead, should they wait for the ATO to send notification to the super fund for additional tax when the PAYG statement and the fund records do not reconcile?
Yeah, this is a difficult one for the humble, hardworking accountant to fix, particularly when the fund is telling you that they can't fix it. So it is a difficult one. We acted for a client who had a similar circumstance, and this matter is still ongoing. Effectively, they wanted to do a rollover of a fund, and for whatever reason, the fund that they were rolling over into incorrectly recorded it as a contribution. And obviously it was above the threshold for contributions for that year, and the taxpayer was assessed about $50,000. Essentially, in that case, there was no drawdown issue, so we could go to the super fund and ask them to rectify, which they did. We did have to lodge an objection to kind of get the ATO to, I guess, withdraw. Hopefully, it still hasn't come through. But obviously that circumstance is slightly different to what you're saying, because your fund isn't going to, I guess, assist you. In terms of, I'll come back to kind of the final resolution, but in terms of the Division 7A issue, I can't see that actually being an issue to be worried about. For starters, if this is an employee, not a shareholder, even if it were a payment directly to the shareholder, which it isn't, they're not, I guess, a related party of the company. It's very unlikely that they would consider it to be the fund to be an interposed entity between the company, because it's not reasonable to conclude that all of these things would have, I guess, come together to pay that money from the fund onto the employee. So I can't see Division 7A being an issue. Unfortunately, I think probably the only way is, there's two options. One is to go to the ATO and say what's happened and try to get some, I guess, direction from them, or, as you suggest, simply wait until the records don't reconcile and deal with it at that time. Don't have a great answer, because ultimately, it's a confluence of errors that have occurred all through, a simple mistake. I would have thought that there would be some way of getting it rectified, but it will likely be that the client has to simply wait until it comes up in that I guess annual statement.
Thanks, Paul. We've now gotten through all of the questions that were previously submitted to us. We do have a few minutes left over, and we do have a few which were sent through via the chat, so I might ask one or two more of those. I'll let you volunteer for whoever wants to answer it. The first one comes from...
Kate?
No, I meant out of you and Adrian. First question comes from Amir Ishak in relation to a discretionary trust. So we have the director of the trustee company. They're in Victoria. The trust will be buying a property in Queensland, and the settlor of the trust is in New South Wales. So a few geographic issues there. For the trust, where should the trustee be established? Should it be Queensland, where the property is located, or Victoria, where the director is? And the second part of that question, what should the jurisdiction be in the trust deed?
I guess I'll give mine and you can jump in, Adrian. But look, I think state of registration of the company is less of an issue now that we have a centralised register. But there are some quirks to, I guess, to trust deeds that can be affected by the state of registration. For example, our trust deed has a provision that does change the jurisdiction if you appoint a trustee from a different jurisdiction in some circumstances. So that might be something. I would probably be going for a Victorian-based company, just because that's where the director is. In terms of the only, I guess, the jurisdiction issue is generally it will be a New South Wales-based deed, I would have thought, because the New South Wales duty laws would impose duty in that state because it is signed in that state. But I'll let Adrian correct me if I'm wrong there.
No, that's where the settler is, so they're commencing the trust. I think it particularly matters what state that you say it is in.
All right, I think I'll ask one more and then we can probably sign off for the webinar. This one's from Peter O'Loughlin. The question is, what is the proper way for an appointer of a discretionary trust to appoint a new trustee in place of the original trustee? And further to that, can the appointer become the new trustee?
I'll field that one, Paul, and I'll do the next one that I've seen come up as well. Okay. So in terms of the, it will depend on the deed. Using ours as an example, the proper way is for the appointer to nominate who the new trustee is. They can be the trustee. There's a couple of issues in terms of different states. For example, in New South Wales, if the trust holds land, then there's some requirements in terms of who can be the new trustee. But that's not aside from that, our deed isn't the only deed out there, of course, and I've seen other variations where somebody else has to consent to it, or you might have a guardian clause who has to consent, or notice has to be given for 30 days or 6 months. So it comes back to the deed. But for the most part, it's the action of the appointer in doing that. And I'll just read the next question, Kate, if that's okay with you.
Sure.
So the question is, and it's again kind of along the same sort of topic, so I'll combine them. Is a day trader, he shares crypto carrying on an enterprise, or is merely receiving revenue? And if a blogger has subscribers to his blog, is that income PSI? Interesting questions at the moment. I don't know if you saw in the Fin Review a couple of days ago, they had an article where the ATO have said they're going to attack COVID side hustles. I think you would think they have better things to do with their time, but apparently they're going to go after people who've been making money on the side during COVID by launching online enterprises or something similar. Again, it comes back to that earlier question in terms of really it's about the dog walker. It's a question of scale and business activity, so to speak. For the day trader, traditionally, they're not going to be carrying on an enterprise. People have tried to argue it either way, depending on what suits them. But my experience in terms of currently with the ATO is they would say most people who are day trading, not in a very large scale, are not carrying on a business. For the blogger, is it PSI? I would take the view that it's income from property being the website as opposed to PSI. Paul may want to correct me on that or may not. But that's how I'd respond to those two questions.
All right. Well, thank you both, Adrian and Paul, for fielding all my questions today. Thank you, everyone, for tuning in. And thank you also to all the LRC members who submitted their questions for today's session. We hope that you were able to tune in today and have your questions answered. As I mentioned at the start, please keep an eye out for our feedback email, which will be circulated a bit later. And hopefully we will see you all at our next webinar in a fortnight's time.